Very best life has to offer with Tyler Matheson as he speaks to the ultra-affluent on the latest investing trends and opportunities. Enter the world of excellence and gain VIP access with the Luxury Channel and High Net Worth weekends on CNBC.
Serving you a world of choices at 35,000 feet, flying to over 80 destinations. Qatar Airways, the world's 5-star airline.
CNBC's Worldwide Exchange.
I'm Christine Tan. Sinopec leads a surge in Shanghai, limit up on speculation that China will soon hike domestic fuel prices.
I'm Rebecca Mee, and in Europe, equities fall in early trade as concerns over banks continue to weigh, while oil stocks track the price of crude lower.
And I'm Rebecca Jarvis. In the U.S., the banks and transports take the spotlight today as Morgan Stanley and FedEx get set to report their results.
Hi and welcome to CNBC's Worldwide Exchange. Well, let's start our markets run today with a look at the FTSE CNBC Global 300 Index. Let's see what's going on. We're actually a little bit lower. We've just turned lower, having been actually in positive territory for most of the morning so far. Low by about 1/10 of 1% so far, however. Let's look how that translates to the European bourses. We have been open for a little while now, so hopefully have found a bit of direction. And it looks like we really do have a lower trading day. The FTSE is declining by the most of the three major indexes, at least, lower by about 0.8 of 1%. The DAX across in Germany, the more modest gains, down by about 0.5%, and the CAC is down by about 0.7. Across in Switzerland, we have the SMI lower by almost 1%, in fact, at this stage. Let's also take a look at the Forex markets very briefly to catch up on what's going on there. The dollar is gaining a bit of ground against the yen. The dollar has been dropping the first couple of days of this week so far. Pretty flat against the euro at 155.18, and sterling dropping back a little bit against the euro at this stage, down at about 195.30. A dollar Swissy at 104.27. Christine.
Hey, Becky. Well, almost all markets here in Asia are up today. Bargain hunting, some of them coming back into the market. Sentiment looking rather good, reversing early losses because of that dip in oil price. The Nikkei closed up 0.7%. The Shanghai market, this is the big focus. Take a look at that. Up more than 5.2%. This was because trade talks from the U.S. has sparked speculation that the oil refiners could see improving margins because Beijing will have to sooner or later hike domestic fuel prices. That seems to be giving a big lift to the Shanghai market. And speaking of oil, let's take a look at that. Little change when it comes to oil prices. The last time we checked, trading range bound. NYMEX right now up 7 cents, $134.08 a barrel. And Brent also should be similar track as well, up 17 cents, $133.89 a barrel. We are looking at the big oil meeting in Jeddah on Sunday. Iran now says it will hike output as long as OPEC agrees to push for one. Saudi Arabia is expected to announce a boost in output at that meeting. Traders are also waiting for weekly U.S. inventory data, and that will be out at 10:30 a.m. New York time. A Dow Jones survey calls for oil stocks to fall by 1.2 million barrels after a much bigger than expected decline the previous week. Gasoline is seen rising by 800,000 barrels and distillates by 1.8 million barrels. Refinery run rates are forecast to rise slightly to 89%. Let's check food prices. They are up today. We are adding something new to our chart today. If you take a look at that, prices for live cattle, we are focusing on that because it is in record territory today due to high feed costs, and that may force producers to reduce their herd size. Here's a bit of trivia for you. It takes 6 pounds of corn to produce 1 pound of beef. And looking at corn, take a look at that, up more than 1%, 1.3 to be exact. Rebecca.
Christine, yes, certainly the agricultural names in focus this morning with the floods in the Midwest portion of the United States. Futures also in focus today. We've got Morgan Stanley on deck to report, FedEx as well. As you can see right there, we are basically hugging the flat line this morning, slightly positive for the Dow and the NASDAQ versus fair value, and just slightly off for the S&P 500. The bond yield also in focus today. Of course, we mentioned that oil inventory report in the dollar. The bond yield now up a little bit this morning. 4.6% is the yield on the Bund. And as far as the 10-year yield goes, we do see that also tracking higher today, 4.22%. Gold prices, they've been tracking lower, but they're now holding near the flat line as well. If you take a look at the boards right here, they are up just a little bit this morning. 888.1 is the price there, or 0.1% higher. Joining us now for some market strategy is Thomas Roaming. He's the head of Fund of Funds Come Invest, and Niku Hirachi, the CEO of N1 Asset Management. And gentlemen, welcome to the program. Thomas, let's begin with you. A lot of talk about the story in the Telegraph today, this very threatening story, or as far as the market health goes, about RBS basically telling its clients, essentially in a letter about the credit, that they are very concerned that we could be heading for a crash. Up till September, the S&P 500, they're saying something about losing 300 points. What's your take, Thomas?
No, we don't have such a negative view on the markets. We think that markets will still see some volatility until the end of the year. But I think a lot of the work has been done, despite of some problems in the financial sectors. We, for our strategy, are still underweight in financials. So we see there most of the problems, but we don't have such a pessimistic view as our colleagues.
Niku, what's your take? Will we see a crash in the markets, a la what RBS has told the Telegraph?
As for a long time, even, I think for the past 18 months, we at N1 and I myself, we've not been positive on the equity markets. I think we were seeing, throughout 2006 and throughout 2007, we've been seeing excess liquidity driving the markets. Right now, obviously, we are seeing lack of liquidity. But having said that, we simply think that there's so many factors in the global economy. Let it be the commodities, let it be the energy, let it be the soft commodities. Even among the soft commodities, we're seeing across the board the highest prices in record. Let it be real assets like the housing market, where we're still going to see falling prices from our point of view. We certainly do not think that this year is going to be an easy one. We think, as I said, lack of liquidity, increased volatility, and I do agree with RBS that we are going to see a much further downturn in the equity markets across the world.
Niku, hi, this is Christine here. In that report, RBS blames rising food prices and energy and how that contributes all to the inflation. As you know, inflation is a big problem these days. That's causing a lot of jitteriness in the market. How do you hedge against inflation?
Well, it's always, that's always the question. How do you hedge yourself? How do you hedge yourself versus inflation? Since we are a fund of diversified hedge funds, we look at our portfolio and we just right now make sure that we expose more to very defensive strategies, and we make sure that we have managers who has proven themselves in the past 6 months, but we think the economy has taken in a new cycle, that they have shown very low correlation to the equity markets.
Okay, Thomas, what about you? You've earlier said that, you're not as pessimistic as RBS, and how markets then? Do you hold more cash, and do you, play more gold to hedge against inflation? How would you play the inflation story?
So we play or hedge ourselves a little bit against the inflation story with investments in the commodity area. It can be soft commodities or energy. We also have some positions in resource equities, so these equities are still up on a year-to-date basis. And we think that a lot of this news which are on the table now, the discussions about inflation, we saw a downturn on the bond market. We think that a lot of these inflation fears are already priced into the market. So there will be some opportunities, we think, in the next 3 to 6 months for the equity markets.
And Thomas, I see that you are overweight European small and mid caps. Can you be a bit more specific about where you see some of that value?
Specifically, European small and mid caps were got a real big hit last year relative to the large cap stocks, and they are not as badly positioned as a lot of market participants think. So a lot of small cap managers focus on small cap stocks which have a very good balance sheet. We have very little exposure to financial stocks or financial services stocks in that area, and they are doing a quite good job still. And we are focusing in that area to small global leaders in their niches.
Niku, if I can put a similar question to you, I noticed that you also are looking for some of the small caps. Can you be a bit more specific about where you see some value in the small caps?
Is the best view as of now in the markets, actually looking for some good stocks in the small caps market. As I said before, we are a fund of hedge funds, so we don't take equity positions ourselves. But if you look at the Asian market, I think where you could maybe find some good opportunities would be in smaller sectors that are actually decoupling and not so depending on the global economy. We think, for example, that right now what we are seeing between Taiwan and China, that the two countries are really politically coming together. We are seeing direct flights coming from 4 different airlines. So we think that this, as it did for Hong Kong a few years back, could really boost the inflows of tourism. So we think that small caps in Taiwan that are focused on tourism and infrastructure, this could offer an opportunity.
Niku Harachi and Thomas Romig, thanks so much for joining us today.
Thank you.
Another story we're watching today, the World Economic Forum has released for the first time, apparently, a global enabling trade report. The index measures and ranks 118 economies around the world based on openness to trade